Bad debt procedures. If your business has few or no bad debts, you can skip through this chapter quickly. Unfortunately, most builders do have fairly significant bad debts, despite the protection most states offer under lien laws. Bad debts can be a big profit drain on your business. You need to understand how to handle them correctly to reduce your bad debt losses. When you sell on credit, the money owed you is income that's booked or recorded as an account receivable. But you know that you won't always collect all that money. From time to time, you'll have bad debts. That's why you need an accounting system that allows you to budget expenses and plan for the future by letting you record the actual bad debts, helping you analyze your collection trend. When an account becomes uncollectible, you must reverse the income you recorded previously. To do this, you write off an account in both the general ledger and on the customer's account ledger. You could write off the account on the sales journal itself, but that's not what most accountants recommend. Instead, make a special journal entry rather than record the amount uncollectible as a sale in reverse. This process, adjusting by journal entry, distinguishes the write-off as a special transaction. It's better to isolate the entry as an unusual occurrence. When does an account become uncollectible? Generally, you should write off a bad debt only after exhausting all efforts to collect. For any significant amount, telephone until you're convinced the customer can't or won't pay. But the rules change if you receive notification that the customer has filed for bankruptcy. At that point, the law provides a procedure for filing a claim for payment. Further efforts at collection may violate federal law. For tax purposes, bad debts can be recognized only when a debtor's business is abandoned and worthless. He can't be contacted. He passes away and leaves a worthless estate. So for a true bad debt, the possibility of collection must be just about non-existent. If a debtor dissolves his business, but has net assets, his liabilities may be paid. If he moves away, you must try to contact him before you can claim that he has disappeared. And if he dies, the debt is transferred to his estate. Journal entries for bad debts. If you do a lot of business on credit, your bad debt losses will be fairly predictable. Your general ledger should include an allowance for anticipated losses. You do that by establishing a reserve for those losses. That's a reduction of your total accounts receivable. No matter how you estimate the amount of these losses, the provision for bad debts is an estimate of bad debts for the month. The allowance is balanced by a similar amount in bad debt expense. The entry in your journal would look like this. This is a provision, an amount which you estimate will cover future losses. When an account becomes uncollectible, the bad debt is recorded. Since you have already provided for this and other losses and have recorded the expense, the entry to record the bad debt is. This entry reduces the reserve for bad debts by the amount of the actual debt. It's proper to record the expense as an estimate earlier because you want to recognize the loss when you record the sale. The losses you take in the future will occur on accounts you now have as receivables. Setting up a reserve for bad debts has some important advantages. First, your books are useful to you only if they reflect what is really happening in your business. Your profit and loss statement each month should tell you how well your company is doing. If you don't reduce monthly profits by the bad debts you expect, your books won't truly reflect your profitability. Second, and perhaps most important, your business pays taxes on its profits at the end of each year. If you don't adjust your accounts receivable for bad debts that are sure to occur, you pay federal and state income taxes on profits you will never see. For these reasons, most companies that have significant and regular bad debt write-offs set up a provision for bad debts. Estimating bad debts. There are two common ways to estimate bad debts. First, you can analyze your accounts individually and calculate your estimate on a case-by-case basis. This is practical only if you have a limited number of accounts and are in close contact with your customers. In a situation like this, your educated guess would probably be better than any formula for predicting future losses. Because you don't know what your actual losses will be, your bad debt reserve like other reserves, is always an estimate. The estimate is more accurate if you use your past collection record developed over several years. Compare actual losses to sales on account for a 2-year period to find your typical loss ratio. If your loss experience begins to exceed this ratio, you should look for the reasons for the trend. But remember that your estimate for bad debts should be reasonable. For example, a single large bad debt in the past year might distort the current estimated uncollectible accounts. Exclude unusual situations from your analysis to get a fair picture of your future. On the other hand, you might know of one or more large problem accounts currently on your books. If this is so, you might want to increase your estimate of uncollectibles for the coming year. Figure 5-1 shows a bad debt study. Just as in Chapter 4, the March numbers have been extended and are used here for May to show a longer trend period. The figures in column 1 are actual bad debts. These amounts have become uncollectible in each month and were charged against the reserve for bad debts. Credit sales are broken out from total sales because only credit sales become bad debts. You could use the total sales figure, but any variation in Figure 5-1 bad debt study. The ratio of cash sales to credit sales would invalidate your estimate. Column 3 shows the ratio of bad debts to total credit sales. A ratio expressed as 1 to 48 means that 1 out of every 48 credit sale dollars became a bad debt. Total credit sales, actual bad debt losses, equal to bad debt ratio. Column 4 shows the year-to-date ratio. This is computed the same way as the monthly ratio, except that year-to-date totals are used rather than the monthly totals. For the first quarter, total credit sales in January, February, and March. Actual bad debt losses in January, February, and March. The year-to-date ratio is the key figure to watch. It's the monthly update of the year-to-date ratio that shows the trend of your bad debt experience. The month-end balances of accounts receivable exclude retainage. The figure in column 6 is recorded as the reserve for bad debts and is computed by dividing the month-end receivable balance by the year-to-date bad debt ratio. In this example, the divisor is the year-to-date ratio at the end of the previous quarter. Using the ratio for the previous quarter avoids distortion that would result from a heavy or light write-off in a single month. The ratio you develop should vary only with sharp changes in your accounts receivable balance. Month-end balance of accounts receivable equal to reserve for bad debts for the current month year-to-date bad debt established at end of previous quarter. The bad debt study gives you a quick method for reviewing your bad debts, creates a useful record of bad debt experience, and shows the trend of problem accounts. Figure 5-1 shows that the previous year's bad debts were $1 in every $48 of credit sales. The year-to-date bad debts as of May 31 were $1 in every 76% of credit sales. If this ratio holds throughout the year, Johnson Construction has improved its collection picture. If you want to refine your analysis of bad debts, take a few minutes each month to prepare a bad debt trend report like Figure 5-2. This report lets you use your past records as a guide to evaluate future collections. The ratio of credit sales to total sales in the fourth column is an important figure. The trend of these ratios shows the trend of your business. In the example, total sales remain about 1.14 to 1 over credit sales, but bad debts are decreasing as a percentage of credit sales. That's a favorable trend. If bad debts were increasing against a steady credit sales volume, the trend would be unfavorable. The ratio of delinquent receivables to total receivables shows a decrease. This is a good trend. Remember, the older an outstanding balance becomes, the more likely it is to become a bad debt. Ratios are very useful in understanding the relationship between numbers. The numbers on your general ledger and on your financial statements represent very real things: cash in the bank, lumber stacked up in your warehouse, or a loss from an uncollected account. The significance of those numbers is more apparent when expressed as a ratio. The dollar amounts don't tell the whole story. For example, assume that bad debts for 6 months were Figure 5-2 bad debts trend. True, it looks like bad debts are rising at an alarming rate. But if the volume of credit sales were also increasing rapidly, the ratio of bad debts might actually be decreasing. It is unlikely that you would experience a rate of growth that rapid. But the example does show that the dollar figures themselves don't always tell you what you need to know. The ratio is the key figure to watch. The following calculations were made to compute the two ratio columns in Figure 5-2. Total sales, total credit sales equal to credit sales ratio, total receivables. Delinquent receivables equal to delinquent ratio. Delinquent receivables are the amounts due more than 30 days. They have a predictable effect on bad debts. For that reason, Figure 5-2 includes the year-to-date ratio of bad debt losses to credit sales. From Year-to-date ratio summary credit sales and bad debts for the year 20. Figure 5-3 year-to-date ratio summary. Column 4 of Figure 5-1. Gather all this information on one worksheet. This gives you a good picture of your collection experience. Summaries like the Bad Debts Trend Report are valuable because they support the financial statements required by your bank or bonding company. Back up your claim that you can collect a high percentage of your accounts receivable with a report like Figure 5-2 covering a 2 or 3 year period. Lenders must rely on the loan documents you provide. Since they don't know how collectible your accounts are, a good historical summary will help you to prove your case. Figure 5%-3 is a year-to-date ratio summary. This information comes from the ratios in Figures 5-1 and 5-2, but excludes dollar amounts. The ratios in Figure 5-3 help determine what steps you should take to avoid uncollectible accounts. Read the information in Figure 5%-3 for January as follows. There was $1 of charge sales for every $1.14 of total sales. In the same month, $1 in accounts receivable was delinquent for every $69 of total receivables. We wrote off $1 in every $39 of credit sales. The example shows these trends. The ratio between credit sales and cash sales is about the same in May as it was in January. The ratio of delinquent receivables declined from January to May. The amount of total credit sales resulting in bad debts is about half in May of what it was on the average in January. Why is this information valuable? Because you have to understand what you're doing right and wrong before you can do more of what you should be doing. In the example, the trend is favorable. Delinquent receivables and bad debts are declining together, the result of good management. This is happening while the relationship between credit sales and total sales remains about the same. But the following would indicate an unfavorable trend. Increase in delinquent receivables. Delinquent receivables remain the same while bad debts increase. Delinquent receivables and bad debts remain the same while credit sales decrease in relation to total sales. Developing information about your receivables requires only a few minutes each month. When you have compiled data for several months, a comparative study of the information will be more valuable to you. You must control your accounts receivable. To do that, you need to know the trend of your credit sales and bad debts. A builder who has a high ratio of bad debts doesn't have well-defined procedures for extending credit, billing his customers, and making collections. Don't ignore future bad debts when you prepare your cash forecast. Without a good projection of bad debt losses, your estimate of available cash can be totally wrong. Cash budgeting is explained in Chapter 14. Accounting for bad debts. 2 accounts were introduced in this chapter: reserve for bad debts and bad debt expense. You make month-end journal entries to record the provision for bad debts and the offsetting expense. When actual bad debts occur, reduce the provision and the accounts receivable total by the amount being written off. When an account becomes uncollectible, update the customer ledger cards to record the same bad debt that flows through the general ledger. If you don't do this, your customer ledger control card won't balance to the general ledger's total for accounts receivable. The reserve for bad debts account is a reduction of your current assets and should appear in the general ledger immediately after the accounts receivable. When listed on a financial statement, the following order is standard. Following this partial listing would be the remaining current assets, such as the earned income account, bad debts, and cash systems. The procedures described for booking bad debts are relevant only if you accrue income. You reverse income by journal entry because you can't collect the money. The process is different when you keep your books using the cash accounting method. On a cash basis, the bad debt is just as bad, but you haven't recorded as income money that you will never receive. Remember, in the cash accounting system, income is booked only when you receive it, so the bad debt actually never makes it onto your books. How do you keep track then? Some firms have receivables, but keep their books on the cash basis. This is perfectly legitimate. However, you still need to keep track of receivables and, of course, of bad debts. In this situation, the records you keep for accounts receivable are identical to those you keep in the accrual system. But the accrual entries remain in an accounts receivable ledger as a subsidiary system and are never entered into the general ledger. In this situation, you need records outside the accounting system. In cash basis accounting, the books contain only cash transactions. Matters such as receivables and bad debts take place elsewhere. Refer back to Chapter 4 for more information on recording and managing receivables. If you do business on credit, there's no way you can eliminate all bad debts. But if you follow the procedures outlined in this chapter, you can keep bad debt losses under control and learn from your mistakes before they do serious damage.